Hi everyone, welcome to this week's webinar. For today's session, we are going to be talking about trend strength trading strategy. We are gonna give about 2 more minutes to let more people join our session before we get started. So in the meantime, let me know if you guys can see me and hear me. And yeah, we'll see you guys in about 2 more minutes. Thanks everyone. Okay, let's go ahead and get started. So as per usual, before we start, a disclaimer and risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss, including from any information contained herein. Every distribution of the material is strictly prohibited. I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here is our agenda for today. We're going to talk about trend trading, how we can identify a trend, different indicators, and trend lines, trend channels, how to trade it, disadvantages, and how to overcome those disadvantages. Okay, so what is trend trading exactly? So firstly, it's a popular strategy used in Forex market by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trading can help you to make more informed trading decisions. So it's basically based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. So the goal, okay, these movements can be upward, referred to as an uptrend, or downward, referred to as a downtrend. But the goal of trend trading is ultimately to identify and capitalize on these sustained price movements. Statistically, a trend is more likely to continue than to reverse. So that's why we normally will advise you to just follow the trend. So that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. So we'll show you some examples of when you can expect the trend to reverse in the later slides. Okay, that's also kind of why some people say the trend is your friend and you should never go against the trend. So by looking at the different time frames, staying away from markets when they're not trending, this can also increase your profit-making opportunities. So we'll go through a couple of those strategies in a little bit. So here's basically how it works. Firstly, you want to identify the trend. So by looking at a chart, it's pretty easy to see if it's an uptrend. That would be higher highs and higher lows. Downtrend, there would be lower highs and lower lows. Entry points. So once you've identified the trend, the next step is to find an opportune entry point. So in an uptrend, you might look to enter a trade when the price has retraced, which means pulled back from its recent high, anticipating that the trend will continue. In a downtrend, you might look for a retracement before the price continues its downward movement. Number three is setting stop loss and take profit levels. So to manage risk, it's really important to set proper stop loss and take profit levels. We do go through some of those in our other webinars. I'm not going to get too in-depth in this today, but feel free to let me know if you guys have any questions. But basically, the stop loss is, of course, a predetermined price at which your trade will automatically close to limit your losses. And a take profit level will obviously be when when you exit the trade to lock in your profits before the trend potentially reverses. So next is riding the trend. So once you're in the trade and the trend continues, you should aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and your take profits, your take profit levels if needed. Next is exiting the trade. So eventually, the trend might reverse, excuse me, or weaken. So at this point, it's important to decide to exit the trades and take your profits. So trends don't really last forever, so it's important to be vigilant and not be too greedy. And lastly, practice and analysis. So this is pretty straightforward by just refining your technical skills, setting your charts, and staying updated on your fundamentals and market news and events that could also impact currency prices. Okay, so how do you identify a trend? So there are two ways to do this by drawing a trend line or a trend channel. So some ways to identify valid trend lines is basically by looking at ascending trend lines and the number of touches. So an ascending trend line should be from the bottom, not the top. Trend line should have at least 3 touches, and 2 touches tends to be more coincidental. That's why we go for 3. Okay, so here's an example. Another example here. Okay, so when you're drawing descending trend lines, your trend lines should be drawn from the top. And again, they should have at least 3 significant touches. By significant, we mean you should see a very clear market structure, a price structure, something as clear as this. And again, 2 touches tends to be too coincidental. Okay, here's an example. Here we have about 4 touches on the trend line, so you know that this downward trend is pretty strong. Again, we have 4 touches here. Okay. So again, here we have at least 3 significant touches, so we have a valid trend line here, and we expect price to continue in that downward downtrend. Okay, so let me know in the chat if you guys think that this is a valid trend line. Keeping in mind everything that we just went through. Okay, we have some replies. Okay, someone says it's valid, some say not valid. Okay, so it's actually not valid because if we go back to our previous slide, for it to be valid, even though over here there are three touches, it's a downtrend, so we should be drawing the trend line from the top. Okay, so this is an invalid trend line. Okay, let's move on. Okay, so next let's look at the second way to look at trends. It's by drawing valid trend channels. So channels require at least 4 significant touches, 2 at the top and 2 at the bottom. So they don't need to be in consecutive order like the picture over here. It can be like this. Okay, in this picture it's also consecutive. But this is an example of a downtrend. This is a picture of a uptrend. Okay, pretty straightforward. So now let's talk a bit more about the different indicators that you can use to identify the trend. So the first one that we'll go through is Ichimoku, and this is the one trend indicator that I use most often because at one glance you can see exactly what the trends are. Okay, excuse me. So if we're just looking at the cloud, which is what I tend to do, prices that are moving below the cloud, like you see here, they are moving in a downtrend. So it's a bearish signal. Once prices move above the cloud, it is then moving in an uptrend, so it's a bullish signal. So it's a very easy way of spotting the trend. But of course, if you're familiar with Ichimoku, there are different lines that comprise of this indicator as well. Okay, so it consists of several components, including the 5 lines. So I'm not going to try to pronounce each of the lines now. But 2 of them comprise a cloud where the difference between the 2 lines is shaded in, which is the one that I was talking about previously. The next are the lines, including a 9-period average, 26-period average, and average of those 2 averages, 52-period average, and a lagging closing price line. Okay, so the cloud is the key part of the indicator normally, but you can use Ichimoku to identify trends for support and resistance, confirmation, and buy and sell signals as well. Okay, so now let's quickly break down the different lines that you can use to spot the trend. So this is what I mentioned earlier. When price is below the cloud, the trend is down. And when price is above the cloud, the trend is up. So trend signals are strengthened if the cloud is moving up. If the cloud is moving in the same direction as the price. So during an uptrend, the top of the cloud is moving up. During a downtrend, the bottom of the cloud is moving down. Okay, so for these are the different lines that are involved, or rather that are part of our Ichimoku. Okay, we have the Tenkan-sen, which is the blue line. This is the average of the highest high and the lowest low over the past 9 periods. Next is the Kijun-sen, which is the average, the red line here, the average of the highest high and lowest low over the past 26 periods. Chico span is a lagging indicator, and the current closing price plotted 26 periods behind the current time. Then we have the Senko span A and B. Both of these are the average of the Tenkan Sen and Kijun Sen plotted 26 periods and 52 periods ahead of the current time. Both of these are leading indicators of the trend. Okay, so let's explain the lines a little bit. Firstly, we have the Tenkan Sen, which is blue, and the Kijun Sen, which is the red line. So these are both used to identify the trend of the market. A bullish trend occurs when the Tenkan Sen moves above the Kijun Sen, and a bearish trend occurs when the Tenkan Sen moves below the Kijun Sen. Again, the Tenkan Sen is the blue line, Kijun Sen is the red line. If you just look over here, it's pretty obvious. You can see when price is moving in an uptrend, your blue line is moving above the red line. When it's moving in a downtrend, the red line moves above the blue line. And again, blue line moving above the red line since it's moving in an uptrend. Okay, so pretty straightforward and easy to identify here. Second way to use the Ichimoku indicator is through support and resistance. So the way to go about this is by using the Senko span A and B. So if the price is above the Senko span A and B, it's considered a bullish market. And the Senko span A and B can act as your support levels. So these two levels basically outline the cloud that we were talking about before, but you can also use the outline of the cloud or these two lines as your support and resistance levels. So if the price is below the cloud, basically it's a bearish market like we discussed, and then our lines can be used as resistance levels. If it's a bullish market, like over here, your lines can then be used as support levels. Okay, the third way to use Ichimoku is confirmation. So the Chico span is used to confirm the signals generated by the previous lines that we talked about before. So if the Chico span is above the current price, it confirms your bullish trend. If it's below the current price, it confirms a bearish trend. Okay. Lastly, you can also use it for buy and sell signals based on the positions of the various components. So a buy signal is generated when the Tenkan span crosses above the Kijun Sen, and a sell signal is generated when the Tenkan span crosses below the Kijun Sen. Okay, so the fastest and most efficient way to use the Ichimoku indicator is just the way that I talked about before, which is just by looking at the cloud. So the overall trend is up when price is above the cloud. Price is below the cloud, it is a downtrend. It's trendless or it's transitioning when price is within the cloud. Okay, so we're just giving you some other ways to use the indicator as well, but just the cloud is enough to identify the trend as well. Okay, like over here, this is just an example. You can see when price moves below the cloud, this is a bearish signal. Price moves above the cloud, it's a bullish signal. Okay. Okay, next, let's move on to our next indicator. Okay, so let's look at price and our MA class. So your moving average cross trading is a very simple trend following strategy for beginners. So it involves using two moving averages of different periods to analyze price movements and generate buy and sell signals. So MA as moving average helps to smooth out It's basically a smooth line that represents the average price over a specific number of periods. So it helps to smooth out price fluctuations and highlight the underlying trend. So how you can go about using this is to choose two moving averages. So a shorter moving average can be 20 days, and then a longer period, which could be 50 days. Your buy signal will occur when the shorter moving average crosses above the longer moving average, suggesting a potential upward trend. So you would consider buying in that scenario. And a sell signal occurs when the shorter moving average, so your 20-day moving average, crosses below the longer moving average, indicating a possible downward trend, and then you would consider selling. So an example would be if your 20-day crosses above the 50-day, it's a buy. If 20-day crosses below the 50-day, it's a sell. Pretty straightforward. Okay, so this strategy aims to capture trends, and it works best in trending markets. So like you see in the picture here, price is moving above. So you can see the arrow, the minute it crosses above, it suggests that price is now moving into an uptrend. So then we will go in for a buy instead. Okay, so it might produce, yeah, so since this method or this strategy works better in trending markets, it might produce false signals in choppy or sideways markets. So that's why it's important to consider other things as well. So if you're looking at um, stocks or forex currencies, you look at your fundamental analysis as well as different market conditions before making your trading decisions. Okay, any questions on these two indicators so far? Okay, if there are no questions, let's move on to our next indicator. So next we have the golden or death cross. Okay, the golden death cross is a trading strategy that's based on the intersection of two important moving averages on the chart. So it's basically a term that's used to describe the point at which a shorter term moving average crosses above the longer term moving average. So it's basically similar to what we talked about in our previous slide about the price and MA cross. Okay, so it's just with different terms. So your death cross refers to the opposite scenario, where the shorter term moving average crosses over your longer term moving average, indicating a bearish trend reversal. Okay, so here's how the strategy works. Um, it's pretty much the same way as the previous slide. We're using, of course, moving averages. We're looking at golden cross. Your golden cross is your bullish signal. Death cross is your bearish signal. Your confirmation analysis basically occurs when your shorter term moving average or your longer term moving average crosses over one another. As you can see from the picture, that's basically where we highlighted those levels with the arrow. Okay, so if we're talking about a golden cross, for example, the shorter term moving average, let's say 50 days, crosses above the longer term moving average, if we say maybe 200 days. So this crossover suggests a potential shift from the downward trend or the downtrend to an uptrend, and it might be indicating a possible buy entry. Traders will often interpret this signal as a potential bullish trend reversal, implying that the price may continue to rise. So, for example, if you look at the second arrow, your death golden cross in this situation would be since our yellow line crosses above the black line. And that's why you see prices start to rise as well. For the first part or the first arrow, we see death cross, which is a bearish signal. So a death cross occurs when the shorter term moving average, again, we're going to use the example of 50 days and 200 days, when it crosses below it. Okay, so the crossover suggests that the potential shift from an uptrend to downtrend might be occurring, indicating a possible selling opportunity. So traders often interpret this signal as a potential bearish trend reversal, like we see here, implying that the price may continue to decline, which it did after this. Okay. So again, this is pretty similar to our previous indicator about the moving averages. We're just calling it death cross and golden cross for your bearish and bullish signals respectively. Okay, next let's another trend of course would be our channels that we just went through, how to identify them. In this example, we actually highlighted a resistance level here. Okay, so this resistance level is important because it's an overlap level. So an overlap level is basically when there are swing highs and swing lows that test that level. So that makes it a pretty significant level. And we are expecting price, if price is able to break out of this level, then we're expected to continue within this ascending trend channel. Okay? Okay, so which looks better? The first one or the second one? Okay, yeah, the first one. Because it touches, yeah, all of the points touch your the price, the bottom of the price. So that's how we can use your natural moving average. So, or rather, this is how you can adjust it. So on your trading view or your MT4, you'll be able to adjust the periods that you're looking at whenever you're using this natural moving average indicator. So one way to ensure that you are using this indicator correctly or efficiently is by basically ensuring that the moving average traces the bottom of your price structure. Okay, so this is it's fine, but it's not really preferred compared to the first one. Another indicator that you can use is a double break. So double break is basically when price breaks out of your trend channel. Okay, so we've identified previously how you can um identify a trend channel. You want to make sure that there are two touches at the top, two touches below. But if a double break occurs, that's how you know that price is probably going, or the trend is going to reverse. So here's an example. You can see price breaking out of it, moving in a really strong downtrend. Okay. Next is confluence. So confluence is basically when price, wait, um, okay, these two slides are pretty much the same. Okay, but confluence basically involves using all of the methods that we've gone through so far, or all of the indicators that we've gone through to come to a conclusion. Yeah, that's basically what we call confluence. So in this slide, you can see this is what we did for our trend channels. So firstly, we have a trend channel here, and then we're also using a moving average as well as an Ichimoku cloud. So price is moving in an ascending trend channel. Price is also moving above our moving average, so it is a bullish signal. And Ichimoku cloud is price is moving above the Ichimoku cloud as well. So all of these give us confluence that price is moving in an uptrend. Lastly, we're using the death cross and golden cross strategy as well. So you can see that our shorter time frame or shorter time period, which is the gold, moving above our longer time period moving average, which is this black line. So that's also giving us a golden cross signal. Okay, so ultimately, this is all giving us a bullish signal. So yeah, so it's important, even though we go through it individually, just pick a couple of indicators that you're comfortable using, that you know how to use, and then use them all together so that you kind of form this confluence and a confirmation of your analysis. Okay, any questions so far? Okay, if not, let's then look at trading stop loss. So trading stop loss is more of a risk management technique than a trend following technique. So trading stop loss tends, even though it does follow your trend, since it is a trailing indicator, it does follow the price, but it doesn't, it's more used to get out of a trade. So I'll explain what I mean in a bit. So what exactly it is it's a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So you can read the example on your own. But basically, if the price drops to a certain amount, the stop loss will trigger and then it'll sell your position and protect your profits. Okay, so this allows traders to manage your risk, lock in profits dynamically as the market moves, which is different from a fixed stop loss, which is set at a specific price and doesn't change as the market moves. Okay, so some methods of using your trading stop loss. These again are some indicators that you can use. First is your moving average indicator. Okay, so by using moving average, you're kind of killing two birds with one stone. Since we mentioned earlier, you're able to follow the trend. Here we also see it as a method to use as a stop loss. Secondly, we have the parabolic saw, chandelier, and ATR indicator. We're also going to use the typical horizontal support and resistance levels and a combination of all of these methods. Okay, so let's talk a bit about moving average, or let's just look at some examples. So in this example, we're using a moving average. Um, so this blue line here is our ascending trend line. Okay, we have 3 touches on it, and you can see price has recently broken below that line. That horizontal level that we have as well at 1.57891, that's also a kind of a resistance level or support level, and price has also broken out of that. So it's giving us a very bearish signal. So firstly, we have our sell entry. Okay, so we're correct. We go in for a sell. Price moves below the moving average, which we mentioned earlier is a bearish signal. So it continues dropping, but suddenly there is a spike and the trading stop loss is triggered once price breaks out of the moving average or crosses above the moving average. Okay, so then we're getting out of the trade and we're protecting our profits. And it got us out right before price continued to rise. Okay, on that same chart, you can also use trend lines, just your normal trend line that we talked about earlier. So again, this is the same chart that we're looking at, just using a different method. So by following that trend line, price is moving below it, testing it a couple of times here. So it drops below, and when it spikes up, the trend line trading stop loss has been triggered, and we got out of the trade again. Next, we're looking at parabolic SAR. Again, same thing. Price is moving below our indicator, giving us a bearish signal. Once it triggers your parabolic SAR trailing stop loss, we get out of the trade. So you can see it's pretty repetitive, and all of these can kind of be used interchangeably. Yeah, we're just giving you a couple of options. So chandelier and ATR trailing stop loss as well. I think it's pretty straightforward. Price moves below your indicator, giving us a bearish signal. Once it triggers both of the indicators and your stop loss is triggered, you get out of the trade, protects your position. Okay, so yeah, here's another example. Price has broken out of this ascending trend line here. Okay, so this is our sell entry. Price moves below the moving average as well, and it drops below our take profit, so we get out over here before it reverses and moves above your moving average. Okay, similarly here as well. Okay, so using breakouts as trading stop loss. So breakouts are usually really high volatility events, and price can spike up and reverse almost instantly. So a stop loss will help you to manage your risk, protect your capital, and a trailing stop loss can help you to protect your profit. So here's one way that you can use support and resistance in combination with parabolic SAR, and also moving average, I think. Yeah, moving average here. Okay, so price is moving below the one of your horizontal levels, and then it spikes above. Once price moves above your moving average and parabolic SAR, it's a bullish signal. So you move above, and then your take profit is here. So you get out of it here. Okay, another example here, how you can use not just the price structure, but also the indicators to help you to spot any of these support and resistance levels, which of course, these horizontal support and resistance levels can also be used for your entry and stop loss levels. So that's why it's important for us to be able to identify these levels as well. Okay, and another example here. Okay, so in the next couple of slides, I'll talk a bit about the disadvantages of trend trading and what you can do to overcome these disadvantages. So firstly is false signals. So we talked earlier that trend trading, it works best on trending charts. So if you are using these on kind of sideways charts, you might be it might lead to losses due to false signals. Okay, especially if you are making incorrect trend assumptions. Okay, late entries. So trend following strategies may result in entering trades after a trend has already been established. So you might miss out on the initial price movement and potential profits. Choppiness. So we did mention trend trading works best in trending markets. But in volatile and choppy markets, trends are kind of short-lived and erratic, so it can lead to frequent changes in direction and difficulty in capitalizing on sustained trends. Whipsaw trades. So these are rapid changes in price direction, which can trigger whipsaw trades, where traders enter and exit profits positions quickly due to volatile price movements, resulting in losses. Limited profits in ranging markets. So trend trading might struggle to generate profits in markets that lack a clear and sustained trend, since trends may get caught in a range-bound price movement. It also requires timely decision making, identifying the start and end of trades accurately, and it also requires constant monitoring, which might not suit all traders' lifestyles or availability. Noisy price data. So trends can be distorted by noisy price data, short-term fluctuations, and can lead to misinterpretation of the underlying trend direction. So what are some ways that you can do to overcome trend trading? Firstly is confirmation signals. So you can use additional technical indicators or chart patterns like those we mentioned earlier to confirm trend signals before entering a trade. So that's why we talk about confluence and how you should use multiple trend signals and indicators before entering a trade. Diversification. So by combining trend trading with other trading styles like your Fibonacci, can also reduce reliance on a single approach. Time frame analysis. So it's important to consider analyzing multiple time frames as well to gain a broader perspective on trends and to reduce impact of short-term noise. This is also why we typically recommend you to trade on the higher time frames, and so higher in the sense of 30-minute and above, maybe 15, but we typically will not go lower than 15 minutes due to the noise on the lower time frames. Risk management. So implementing strict risk management strategies such as setting stop loss orders and position sizing based on your risk tolerance to protect capital during drawdowns. Market monitoring. So again, we talked about this earlier, regularly monitoring news events, economic data releases, and so on and so forth, because these can impact your trends and can cause your trends to reverse as well. Okay, so let's briefly talk about multi-time frame analysis since I touched about it a little bit in the previous slide. So it's basically important to look at least two time frames, a short-term time frame and a longer-term time frame. There are a lot of strategies to go about this, but as long as you choose a shorter and a longer-term time frame, that should be good enough to kind of identify the most recent trends and price movements, and then the longer-term time frame to identify the overall trend and general market direction. Okay, and then you can analyze both of these, look at key support and resistance levels, trends and patterns. And yeah, so the example here that we gave is if it's on a short-term trend is bullish, longer-term trend is also bullish, this could indicate a strong uptrend in the market. So here's an example of an unclear market structure from your 15-minute time frame. So it's quite messy, there are no clear movement in price. And when we change to the 1 hour time frame, you can see it's a much clearer price movement. Okay, so when choosing between time frames, there's two criterion that you should look out for. Firstly, a clear swing low or swing high. Secondly, a clear trend between the starting and the ending point. So, yeah, so that your analysis will be more accurate. Okay, so what should you look out for on the higher time frames? Key graphical levels. These are your horizontal levels that we talked about already. Trend lines, trend channels, breakouts, big moving averages. So all of those we talked about already. Ichimoku cloud, which again we also talked about. Fibonacci levels and price action. So price action basically refers to the past, present, and future. It's basically the momentum from your previous bar to dictate your strategy. Okay, and that's all I have for you guys for today. Thank you guys so much for joining me. Let me know if you guys have any other questions. But if not, feel free to just leave the meeting. If you liked me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I will see you guys again next week. Thanks, everyone. Bye. For any questions regarding the accounts, feel free to email IronFX um, on their admin page. I'm sure the email is on the website. Yeah, and I'm sure they'll get back to you ASAP. Bye, Danilo. Thanks, everyone. See you guys next week. Thanks, everyone. Bye. Thanks, Samuel.